Hi everyone and welcome to another Zerodha Educate webinar. Today's webinar is on the topic of passive investing, a phenomena that is slowly taking hold in India. In the US, this trend is much more pronounced. A recent Morningstar estimate showed that of the mutual funds and exchange traded funds that buy US stocks, those that passively track indexes now hold 48% of assets. To put that number in perspective, this number is just about 4 to 5% in India. The reason for this shift is that it has increasingly become more impossible for active managers to consistently beat the markets or deliver alpha. So, in today's session, we'll talk to Gauri Sekaria and Anil Ghelani of DSP Mutual Fund to understand what passive investing means. And honestly, we couldn't have chosen anyone else to talk about the concept. Gauri Sekaria is the fund manager of DSP's Equal Nifty 50 Fund, Nifty 50 Index Fund, and Liquid ETF. Gauri has over 12 years of experience in managing passive funds across various index funds and ETFs. Prior to joining DSP, she worked for Goldman Sachs Asset Management, who were among the first to conceptualize and launch various equity, debt, commodity, and international index funds, and ETFs in India as well. In a way, she has so far had a front row seat to the growth of passive investing in India. Anil Ghelani has been working with DSP Group since 2003 and is the Senior Vice President and Head of Passive Investments and Products at DSP. He previously served as the business head and chief investment officer at DSP Pension Fund Managers, and prior to that, leading the risk and quantitative analysis team at DSP Mutual Fund, responsible for monitoring of portfolio risk. Anil is a CFA charter holder and holds a Bachelor of Commerce degree from the University of Mumbai. Gauri and Anil, thank you so much for joining us today. To set the context, let's start off with the basics. Can you please explain what is the difference between an active and passive investing?
Sure. I think, first of all, Faisal, thanks a lot for this very kind introduction and for setting up this wonderful webinar for all the Zerodha users and clients. From our side, I think I'll try to take this in multiple parts. First of all, I'll try to give a background of what exactly is the key differentiation between an active fund and a passive fund, or what exactly do we mean by passive investing. What I'll try and do is to have a base for our discussion. I'll use a brief presentation slide just to act as an anchor for whatever we are discussing. And as and when required, we'll keep switching back and making it very engaging and interacting in terms of the discussions as well. So if we talk about the core fundamental difference between a passive investment approach versus an active approach, the key to this differentiation is that in passive investing, the whole idea is to meet the market. What I mean by that is that a predefined index or a portfolio of stocks is worked on. Let's take in a simple example that there is an idea to have a benchmark which is a Nifty 50 or a particular index that tracks the 50 stocks in the broader Indian market. Once that particular index is selected, the whole objective is to ensure that there is a very close replication of those particular stocks in the weightage in which the portfolio has to be invested and aligned.
Right.
On a broad way, the active manager or the active management does something different where it tries to outperform that particular underlying index. So it tries to beat the market. So in simply put, if you talk about passive investing, it's trying to more meet the market and trying to ensure you get returns and risk profile exactly in line with what the market is. Whereas in the active management side, the portfolio manager is trying to beat the market by, of course, at some certain point of time, and hence the risk as well as return expectation and objective would be slightly different.
Right. So how is the passive landscape?
I'll define one more key difference in the way in which the two portfolios are handled. In terms of the active management, the implementation is done by stock picking. So what I mean by that is the portfolio manager goes out, meets with multiple companies, meet with management of multiple companies, trying to make a judgment of what the next couple of quarters or a year or two, 3 years, 5 years in the future, how the company's profitability and business growth will happen.
Right.
On that basis, they will select that, yes, maybe this company looks good, this doesn't look good, this falls within my portfolio framework, and they will do individual stock by stock, bottom up stock picking. Whereas
Right.
on the passive investment side, the key concept of implementing the portfolio is mainly in two ways. One is a replication basis. So let's say the entire index or the particular portfolio is replicated exactly in line with what the underlying weightage is. In certain cases where that is not feasible or it's not easy to access the entire basket of all the securities, then what we call as a optimization or a sampling approach is used, wherein the particular basket is selected, which will ensure as close as possible risk and return objective of the total basket. So what this leads to is a low cost investing with a well diversified approach, and in general, it at certain points of time on a cost adjusted basis lands up in a better position to meet the objective of an investor.
Right. Okay. So how has the passive landscape evolved both in India and the world? And why has there been an increasing shift to passive in recent years in the developed markets?
So Faisal, before we give you some color about the Indian market, I think it would be helpful to see how this piece has grown abroad. As we talk today, the passive AUM in the US is close to $5 trillion. Globally, assets under management are about $80 trillion, and from this, ETF is approximately 6 to 8%. Now, if you look at the Indian markets, ETFs account, the American markets, ETFs account for roughly 13% of the total AUM. Now, what has happened is Europe, on the other hand, to give you some more perspective, ETFs are not as popular as they are in the US. Now, even that is changing, and the popularity has happened mostly on account of regulatory framework and market structure. And even now, as we talk, it's continuously evolving, and the focus is more on cost transparency. In fact, if we were to look at some of the research that independent research that is available out there in the markets, they are expecting this size to grow exponentially, and it can at some point touch as much as 25% of the total AUM from the 6 to 8% which is currently there.
All right.
What we are also witnessing globally is that the net inflows to passive funds continue to be positive, while as compared to active funds which are actually seeing outflows.
Okay.
So in that sense, the markets are continuously evolving globally, and India too has seen something similar happening, although it is still at a very nascent stage. Now, if you look at the AUMs which were there in passive funds in 2013, it was less than 10,000 crores.
Right.
But today, if you look at the AUMs which are currently being managed passively, it's crossed 1 lakh crore.
Right.
Now, obviously, that hasn't happened overnight. When passive funds were first launched in India, it was basically on the Nifty 50, right? And then it gained a bit of traction with the launch of gold ETFs.
Right.
But what really, put this entire piece into focus was the disinvestment mandate of the government. We had a lot of disinvestment ETFs. We've seen, issues coming out even recently, and all this has created a buzz in the market.
Right.
And what has also helped is, SEBI's push on cost transparency, moving to an advisory-based model. And, we've had a lot of regulatory changes in terms of, moving from total returns index to price return index, even scheme recategorization for that matter, very clearly defining what is large cap, what is mid cap. So all these changes are eventually, putting more focus on low-cost products. And in that segment, we have passive and ETFs, and we should definitely, see the same growth which has happened globally happening here as well.
Right. Right. Yeah. I mean, as shown in the presentation, so there is a massive increase in the Sensex and Nifty ETFs since 2013. I think it's from 425 is increased to 80,000, I guess, right?
I mean, the current AUM, from 2013, which was around 4,650, 4,600 approximately crores in index funds. We have, from 700 crores, it's grown to 4,600 crores. The total AUM, which is passively managed, has grown from less than 10,000 crores to over 1 lakh crores. So it's around 1,23,000 crores today.
Right, right. So, what's the case to be made for passive versus active? I mean, does this change with investor type and their risk appetites as well?
So I think there are two ways to look at it in terms of some of the global markets and the trends, as Gauri highlighted. There, the shift has happened primarily due to two reasons. One is the lower cost, and the other is that at a lower cost, the portfolio is able to generate the returns of the market, and active managers, which are charging higher cost, are not able to outperform the market. However, in Indian context, I see is slightly different. What I mean by that is that in India, I feel very strongly that still there is a scope for beating the market and performing better than the benchmark and delivering alpha or outperformance over the benchmark. However, that is increasingly going to become a little bit more challenging.
Right.
Hence, the shift will happen, but it will happen gradually. I don't see that overnight people will stop putting money into active funds and there will be no alpha generation. How we see this is that in the large cap space, there is going to be much more difficulty to beat the market, and maybe hence in the large cap space there will be a gradual shift to passive funds. But right now I feel that it will have to be a kind of a complementary strategy. So as we say, not just in investing but in many decision makings, the power of, let's say, and is better than or, right? So instead of investor trying to select passive or active, there could be a better approach to select passive and active. So for some kind of a core allocation, let's say 15-20% X%, as might be suggested by the investors overall wealth allocation by the advisor, investor could actually go to, let's say, the Zerodha coin platform and allocate, let's say, that 20-25%, 15%, whatever XYZ amount into a particular passive fund, let's say a monthly SIP or something of that sort, which will keep going on a regular basis. And for the extra amount over and above that, as a satellite allocation based on some internal inputs or some research, go again to the, let's say, coin platform or equivalent within Zerodha platform and buy the particular active fund.
Right.
So the way in which that would work, it would be very seamless then, whereby one can see that it's not just cost, but there are many other aspects to the decision making.
Right, right. So before we talk about how individual investors can construct their portfolios with passive funds, so I also wanted to ask you about a new category of funds called smart beta funds. Gauri, you manage the DSP Nifty Equiweight Fund, which is a smart beta fund. So can you please explain what are smart beta funds and how are they different from the plain vanilla passive funds?
Yeah, sure, Faisal. But before we actually begin to understand what is smart beta, I'd like to spend some, couple of minutes actually, taking through what are these active funds that we talk about, and then how different are index funds and smart beta or ETFs in that, category. Often, the most common thing I hear during my interaction with market participants is that they tend to look at passively managed funds as a totally different category than mutual funds, right? So, to put there is actually no difference between, say, an index fund, ETF, or an actively managed fund, except the investment philosophy, right? Index funds and ETFs are also mutual funds.
Right.
So now, if, like, Anil mentioned at the beginning of this webinar, he, spoke about the basic differences in the investment philosophy, right? So
Right.
while actively managed funds have some amount of, research and fund manager skill involved in picking stocks,
Right.
you have index funds and ETFs which replicate an index.
Hmm.
Right? So index fund replicates an index. Now, if you look at an index fund that trades on the exchange just like a stock does, they are called ETFs,
Right.
right? But together, all put together, they're all mutual funds.
That's
Now,
right.
smart beta, what that essentially does is, while plain vanilla index funds and ETFs replicate indices, let's say, we have the BSP Nifty 50 index fund, right? Now, that is a plain vanilla index fund which is replicating the Nifty 50. Now,
Right.
if we were to give, if we were to try bridging both the active and passive philosophies, try to find something that bridges this gap, you have something called the smart beta segment.
Mm-hmm.
Now, the simplest form of smart beta is an equal weighted strategy,
Okay.
right? Now, taking the example of our Nifty 50 index fund and the DSP Nifty 50 equal weight index fund, what the equal weight index fund essentially tries to do is it tries to give returns better than the Nifty 50 index fund.
Right.
Right? So to that extent, it is smart in its construct because there is a strategy. You're not blindly replicating the Nifty 50. And it's passive in the sense that there is a Nifty 50 equal weight index. So at any given point of time, the underlying scheme is trying to replicate that index.
Right.
So, for example, if you look at the Nifty 50 index or the Nifty 50 index fund, you will see that HDFC Bank has a weightage of approximately 10%.
Mm-hmm.
The equal weighted strategy, on the other hand, will have a weightage of just 2%.
Right.
Why is that? Because Nifty 50 is made up of 50 stocks.
Right.
Right? While the Nifty 50 index or the Nifty 50 index fund gives a weightage to, ABC stocks based on their market cap, what the equal weight strategy does is that it gives an equal opportunity to all those 50 stocks
Right.
to contribute to the performance and return of the fund.
Mm-hmm.
With 50 stocks, you equally weight them, you end up with a weightage of approximately 2% to each stock.
Mm-hmm. Right,
So,
right.
so this is the simplest form of smart beta.
All right. All right. Thanks a lot, Gauri. So Anil, you did mention that there are other important factors apart from costs that investors should look at. But one of the main reasons for the shift to passive, or one of the most important reasons to invest passively, is that passive funds are low cost. So can you talk about the importance of costs? And also there is something known as a tracking error or impact costs. So can you please throw some light on that as well?
Sure. I think, see, from the cost perspective, what I mean is that one has to look at the cost as one aspect. But
Right.
in contrast to that, if you are getting the potential to outperform, even if by paying a slightly higher cost,
Mm-hmm.
then one wouldn't mind really paying a slightly higher cost and getting a little bit better return outcome. That is what my point was, that besides cost, it's important to see the outperformance. And hence,
All
well, in
right.
the global markets, one is very much attracted towards just low cost passive.
All
In
right.
India, still we are some time away from that, because still there is a potential to beat the market by
Mm-hmm.
active fund manager. And
Right.
hence it will start as a complementary strategy that, okay, no doubt we do feel there is a potential to outperform, but at the same time, let some core allocation keep getting parked into a low cost passive fund.
Right.
So that was one aspect of the cost which I was mentioning. Other aspect, I think you were mentioning about the TCO, right? The total cost.
The tracking error and the impact cost. But yeah, you could speak as well about the TCO and
Sure. Yeah. Okay. So I'll cover both of that because TCO also is a very interesting concept. See, what happens is that over the period, we have got all very used to the concept of TER, that is a total expense ratio of a mutual fund, right? I mean, today, if you go to the coin platform of Zerodha and you look at any particular mutual fund, you will get exact cost of the fund that is getting charged, the TER.
Correct.
However, in case of a ETF, there are certain other explicit and implicit costs also which get added on.
Right.
So let's take, for example, when the ETF has to be purchased from the stock exchange. Of course, in many ways, if it is being purchased through the Zerodha's own platform, then there is no brokerage, because I mean, it's a wonderful platform and there is no brokerage getting charged for this type of delivery-based transaction.
That's right.
But let's say if you are trading through some other not so friendly platform, and let's say you'll end up paying maybe, let's say, 10, 15, 25 basis point of a brokerage.
Right.
So that becomes one part of your cost. So let's say when you buy in the ETF, you will end up paying some brokerage, and you will end up paying, in addition to that, GST on the brokerage.
Right.
Likewise, when you finish the leg of, let's say, end-to-end holding period, and again you want to sell, that time you will end up paying some brokerage.
Right.
Then there will be some kind of a potential to have a bid offer spread at that point of time. So some more, implicit or explicit cost keeps getting added. Let's say, for example, on the time when you want to exit your investment, on that particular day, there is less of liquidity on the counter. So there is a higher spread. So that again adds as a cost to the your exit point or entry point.
Okay.
So all put together, there are multiple small costs which get attached in addition to just the TER of the ETF that is visible optically. So it's important to look at what we call as a TCO, total cost of ownership. And on the other side, if it's a index fund or a mutual fund not traded on the stock exchange,
right,
then the TER that is charged, that itself becomes the TCO, total cost of ownership, because other than the TER, there is no other explicit or implicit cost which has to get added up.
Okay.
So when an investor is investing in a passive product, both are easily accessible through Zerodha platform, either on the coin or on the trading platform.
Yeah.
But it's just that for both, depending on the need or depending on the utility of the investor, one has to be very careful in terms of selecting which one over the other, like an index fund or the ETF, depending on, let's say, if the investor's requirement is to get a particular point of time level. Let's say currently Nifty is at 11,272.
Right.
And the investor is some large institutional investor or some treasury desk who has put some back-to-back arrangement, or let's say a individual investor has done some hedging with some F&O on the Nifty 50 and hence wants to enter into the ETF exactly at that level of 11,272. Then certainly ETF is a better approach because you will get it at that level.
Right.
However, if the, let's say, approach is to just create a wealth on a long-term basis and keep allocating some small amount to equity as an asset class and to a low-cost passive fund in a, let's say, a form of SIP, then whether you enter at that 11,272 or let's say the closing price is 11,200 or 11,300, doesn't matter much basically, because you are going to hold it for a long term. So for that type of an investor, the index fund becomes a much more superior way, because let's say seamlessly on the coin platform, you can put a SIP there, okay, without asking me every 10th of the month or 15th of the month, keep allocating some amount in the product.
Yeah, that's right.
So that is a very important thing. Depending on the investor's need, both are equally beneficial and equally useful. It just depends on the need and the allocation requirement of the investor.
All right. Thanks a lot, Anil.
Yeah.
So a passive fund just mimics the index that it tracks. So for the uninitiated, what role do the indices play?
So the indices play a very important role in terms of providing the clarity or the transparency of what the portfolio will look like.
Right.
So let's say if in the simple example that we were discussing, that there is a particular index called Nifty 50. So the investor knows that yes, my return expectation from this product, let's say which is investing in a Nifty 50, will be very much similar to, let's say, in the last 1 year, Nifty 50 has given a return of, say, for example, 12%. My expectation is clear that my fund will have given return of maybe 11.75 or 12.25. I mean, very close to the 12% level. Other way around, let's say if I have a slightly differentiated, some unique, different product, some smart beta product. Let's take, for example, Nifty 50 equal weight.
Right.
So investor is seeing the Nifty 50 equal weight index on a daily basis. And let's say in this last 1 year, the Nifty 50 equal weight index, just for example, as a measurable against the earlier example, let's say has delivered 15%. So investor knows that yes, my return expectation during this period would be, let's say, 14.75 or 15.25. I mean, very close to the particular level of the index.
Right.
So that's where the relevance or importance of an index in case of any passive fund comes into the picture. And of course, besides that, there are a lot of other things which as a index get utilized by the portfolio manager. So maybe on a daily basis, when Gauri is tracking her portfolio, she would look at the corporate action in each of the portfolio as given by the index provider. On a regular basis, there will be a rebalancing or realignment of the index constituents.
Right.
So that is a very rigorous and ongoing monitoring and aligning of the portfolio with the particular index underlying.
So I think to add to what Anil just said, what indices essentially do is it provides transparency.
Right.
Right. And so an investor knows exactly what they're investing into. And also, given that these funds need to replicate, the underlying indices, it leads to a more disciplined form of investment.
Right.
Like I mentioned, if the whole idea is to replicate an index, there is no scope for directional views being taken on the underlying stocks.
Mm-hmm.
So you know that at any given point of time, your fund is giving the same return as that of the index.
Right. So globally, passive funds also make some money through a mechanism called as securities lending, which is essentially loaning out the underlying shares that a fund holds. So can you talk about how stock lending works, and is it popular in India?
Stock lending, I would think, is still at a nascent stage as compared to what it is globally. Now, what essentially stock lending does is, we have, let's take the example of Nifty 50 stocks, right? Now, the index fund or ETF is holding 50 stocks which make up the Nifty 50. Now, we do know that at any given point of time, we may not have 100% redemptions, right? So what we could instead do is lend some of those securities through the SLB platform, which is provided both by NSE and BSE, and earn some amount of return on the stocks lent.
Right.
Now, the way it happens globally is that whatever return you get from lending these stocks is not passed on to the investor.
Okay.
However, in India, it is passed on to the investor. So whatever we earn by lending securities for a short period of time in SLB is reflected in the NAV of that particular fund or ETF. So it essentially the client earns that interest.
All right.
SLB interest. Now, when we talk about SLB as it's as the platform which facilitates these trades. It's again, like I said, maintained by both the exchanges, NSE and BSE. So to that extent, it is completely transparent. You can have lending in all stocks which are eligible in FNO. There are also some non-FNO stocks which are eligible for trading in the SLV segment. And there are some ETFs as well in which we can trade. Now, as a mutual fund scheme, we can only lend securities.
Okay.
Right now, lending can happen. The platform as such offers multiple, time periods for which securities can be lent, from a month, 2 months, 3 months to longer durations. However, more from a fund management perspective, we would typically, lend it for the shortest duration available. Now,
Okay.
by lending, we don't essentially give up our rights to the corporate actions in the underlying securities, right? Now,
Right.
even if we have lent a stock, let's say HDFC, and there is a dividend in HDFC, right? The scheme is still eligible to receive that dividend. So you
Okay.
are eligible to receive all corporate actions on the security that you have lent.
Right.
And lending typically happens in the range of 6 to 9% annualized returns. It could be sometimes higher if there is some specific news in a particular stock, or let's say it's not part of the top 50 or 100 stocks. So there you typically tend to see higher yields that are happening. Now, all the trades, all the lending trades, lending and borrowing trades that happen on the exchange are guaranteed by the exchange. So, to that extent, counterparty risk is negligible.
Okay.
I would think the only risk that you could potentially face would be an early recall. Now, early recall is, let's say I have lent a security for 30 days,
Mm-hmm.
right? And there is a corporate action like rights, or there is some other news, maybe a merger, demerger that has got announced.
Right.
So, what would happen is that we will have an early recall in that security. So, while I have lent it for 30 days, it
Okay.
will be returned to me before the 30-day window comes to an end. So to that extent, I lose out on what I would have essentially, let's say it gets called within 10 days, although I have, lent it for 30 days.
Mm-hmm.
So I essentially earn for 10 days instead of 30 days as I was earlier.
Okay. All right. To end the session, I have one final question for you, Gauri. Given that you manage hundreds of crores of money across funds, so what does the day in the life of a fund manager look like?
Well, I think coming back to our the topic about what ETFs and index funds are all about, right? It's all
Yeah.
about replicating the index.
Yes.
So to that extent, it would, the day would be more focused on making sure that we are aligned with the underlying indices we are tracking at any given point of time.
Right.
And more importantly, we are in line with all regulations.
Mm-hmm.
So I think the focus is always on making sure that there are no errors, because like I said, we cannot take directional views in any stocks.
Right.
Tracking corporate actions very diligently.
Right.
So paying attention to details is, I would think, more what it is all about.
All right.
So I think I'll just add one point on this. When we talk about the passive fund manager, as Gauri mentioned, the key aspect is that once the particular investment theme or the underlying investment approach, whether a sectoral approach, whether a broad market cap based approach, once that is decided, then the focus is very different.
Right.
The key focus then lands on the making sure eye for detail, making sure very close monitoring, making sure all cash is very smartly deployed. But the lot of analysis and importance is also played at the inception when deciding and framing the particular investment theme or the investment idea, right? So like
Yes.
Gauri, I mean, if I may just highlight, when we also think through our entire process of which particular underlying benchmark to select, whether it should be a market cap based index,
Yeah.
or whether it should be a particular sectoral or a thematic type of a approach, which could work very well as a allocation into the client's portfolio. So at that point of time, a huge level of analysis and review mechanism goes into the framework.
All right.
So basically, the focus would also be on product ideation.
Mm-hmm. All right. Thanks a lot. It's been an honor and a pleasure hosting both of you today. Thank you again for sharing your insights and knowledge on passive investing.
No, I think thank you very much, Faisal and the entire team at Zerodha. I think this particular initiative is really wonderful, and we really are very happy to be associated with it. It helps in spreading the updates about the markets, about the products, and in general knowledge enhancement to a very large number of your Zerodha users. So we really appreciate this, and thank you very much.
Thank you, Faisal.
Thank you.